Let's bring in Kevin Green, senior markets correspondent, to help set up the action today. All right, KG, I know you had a 3-day weekend yourself, so welcome back. I hope you're refreshed. You missed one record on Friday, but you're back clearly for another one. You clearly couldn't miss all the parties. So, but listen, you're always on Twitter X watching the market. So what do you make of where we stand right now?
Yeah, obviously, we continue to see some optimism here in the market, especially its ability to kind of shake off some of the tariff uncertainty as well as the geopolitical risk over the last couple of weeks. And we are seeing, obviously, all-time highs when it comes to the S&P 500. And what you actually saw on Friday as well as Thursday is market breadth actually expanding. So it's not really just being concentrated in communication services as well as technology. You're also seeing some other sectors really perform as well. Financials doing a phenomenal job. Industrial still maintaining and catching a bit, and still making new all-time highs there. So I think the market is very optimistic as to the future, not only when it comes to rate cuts, but also potentially trade policy. It looks like we are also kind of discounting any type of re-rating higher when it comes to those reciprocal tariffs, which could go back into effect, I believe, on July 9th, if I'm not mistaken, for a fair amount of these countries here. So we have the summer lull. June and July are typically actually pretty decent months when it comes to the S&P 500. You have some increased optimism here. Let's see if the momentum is going to be able to continue. If you're looking at valuations, they are a little bit stretched at this point in time. But once again, I think the market's really just trying to find areas of opportunity, and maybe we start seeing value actually outperforming maybe some of these high beta names and tech names here over the next couple of weeks. That would probably be the completion of these new all-time highs, and hopefully solidifies the fact that we've built a pretty decent foundation that we can continue to extend on.
It's interesting you said it. Let's see if the momentum continues. Jay Woods puts out a weekly note on Mondays, and he says momentum and leadership is there for this to continue. Now, he had said before, when we were seeing the recovery, that you'd have this crawl, walk, run phase of the recovery. And he says, and maybe it is time to run. So when you think about momentum and the leadership that he speaks of, you just talked about the broadening out. Where are you expecting to see the leadership, KG?
Well, you would actually like to see the leadership being reflected in financials. I think that would be the key one there, not only just because of the rate cuts moving forward, but financials are really a good gauge on economic growth here in the United States. I think the biggest fear that you have right now, or in the back of everybody's mind, that we are starting to see a slowing. You can see that when it comes to consumer spending numbers. Retail sales came in a little bit light. Initial claims kind of re-rating to the upside, continuing claims kind of inching to the upside as well. And so the fear that you actually have is kind of the stalling out when it comes to the economic data, and that being reflected in some of these very cyclical sectors. But financials, once again, actually holding up pretty well. Berkshire Hathaway, a very big component within the financial sector, also did see a decent little re-rating to the downside after Warren Buffett's announcement that he's going to be stepping down as CEO. So that actually could be another stock that does catch a little bit of a bid after cooling off for a little bit here. So you'd like to see that. Industrials, once again, another one, and not so much just because of the performance of Boeing. Boeing really has pushed that higher, as well as GE, Vernova, and just GE in general. But you like to see some of those locomotive companies, those freight movers starting to catch a bid as well. The CSXs of the world, UNPs, Union Pacific, if you will. Those could also be pretty decent indicators that the market's kind of looking forward to more of an early cycle type of structure rather than late cycle, which is what we've been in over the last couple of, actually probably over the last year or so.
Got it. And I should mention, I know you know who Jay is, but for viewers, that's Jay Woods of Freedom Capital Markets. I'm mentioning his note. And he also mentioned that, look, we're on the precipice of a new quarter, and he points out that institutions have been on the sidelines, and it says that they'll have to play catch up and rebalance portfolio allocations. So does that mean to you, do you see his point here, or would you push back on that point that the path higher seems clear?
The only thing I push back about when it comes to Jay Woods is his choices in NFL teams. That's the only thing. I mean, he's really solid when it comes to some of his other analysis here. He is right when you start seeing, especially for today, these month ends and even quarter ends have been very aggressive. The quarter ends do create a little bit of a rebalancing environment, especially when you're looking at small caps and mid caps. And we usually see that towards the latter half of today. And then we also have some options that are expiring the end of quarter options. The S&P 500 options, we know that the JP Morgan collar is going to run off too. The fact that institutions have been on the sidelines, I would agree to a point. I think I do believe it's a little bit exaggerated, and I'm not saying Jay's saying this, but it's a little exaggerated to say to look at the money market funds that are out there and say, look, there's $6 trillion, $7 trillion in money market funds that are not in equity markets. That's just really not the case. A lot of that is actually capex capital from commercial institutions that want to put it to work in their own. In their own respects, build out infrastructure, things of that nature. So, could you see more money being put to work here at these particular levels? You can, especially on technical breakouts to the upside. But once again, we'll have to see. I think the market's really discounting a lot of the risk. Geopolitical risk right now has been moving to the downside, but there's still some apparent risk that is out there. And then also tariff risk. We're only a headline away. We saw that on Friday, actually. When we saw the president of the United States saying that he's going to stop conversations with China over the trade talks because of this tax that they were going to implement on some of our bigger tech companies. And the market did pull back for a brief stint, and we have seen a little bit of a reversal from Canada on that policy here. So I still think that there's probably some perceived headline risk, but the market's really discounting that right now. And the last thing I want to highlight, if you look at the spot VIX, VIX, and the S&P 500, the VIX is up this morning as well as the S&P 500. That's something that usually just does not happen. On a day like today, maybe that could be the case because we do have quarter end. But when you start seeing that type of environment and you start seeing yields kind of inching to the upside because of maybe some of the policies that's going through Congress, once again, that's something that we have already significantly discounted, and maybe hedging activity might be appropriate at this point, given the fact that volatility is so low.
I'm glad you mentioned that that tax and spending bill that's moving through Congress, the big, beautiful bill as it's being characterized. You mentioned the July 9th deadline. The July 4th deadline is upon us. I mean, I know that's one that the government or President Trump set himself. What are you watching in terms of the impact? It seems like there's mixed reaction from solar stocks, for instance.
Yeah, a lot of mixed reactions in several different fronts when it comes to this bill. And a lot of these deadlines, especially the July 4th one, are self-imposed. And I think that you are seeing maybe some concerns that certain portions of this bill coming from out of the Senate might impact, obviously, a significant amount of industries, not only solar and wind, but also when you're looking at the healthcare industry. But the solar aspect, what actually happened on Thursday, there was actually some rumors and rumblings that the Senate could actually relax maybe some of the restrictions that the House put in place when it comes to solar and wind projects. But it seems like they right now have that, they reversed that course and actually implemented a tax. Now, this tax is going to be very unique. This is going to be applied to projects that are completed after 2027. And if those projects cannot prove that they have not utilized Chinese components within these solar projects or these wind farms, then that's when they're going to get taxed on the consumption. So it's a very unique type of tax, which will be a beneficiary, especially if we're looking at First Solar, which actually manufactures their solar panels here in the United States. But for a lot of companies that are trying to implement this at scale, it makes it a little bit difficult because China actually manufactures around 70% of all solar panels in the world. So it's really hard to go around them in order to put these projects in place. And unfortunately, solar and wind, or fortunately, solar and wind has actually been the fastest growing industries when it comes to utility and power generation here in the United States. So we might actually see a little bit of a stalling. You have seen that stalling happening in the residential front, actually for the last year or so. But do we actually start seeing a stalling on the commercial front? I think that's going to be the big question mark. Or do we see an acceleration of spend from some of these power companies in order to try to get these projects over the finish line? But we will have a gap. We will have a gap. I mean, if we don't provide that much support here, we probably will have a significant gap when it comes to power availability over the next 10 years or so. And I think that's why you're seeing Elon Musk in his commentary today. Unfortunately, we just don't have the battery pack technology to really keep a lot of the power that's being generated on standby. And so there's kind of this back and forth when it comes to ideology, but there is going to be a very big gap for us to be able to fill. And the EIA is probably going to acknowledge that over the next couple of weeks when we have the short-term energy report coming out, which probably will highlight this fact.
And then what are the levels that you're looking for today on the S&P 500? Obviously we're on track for another record. So, but still, let's look for your level for the upside and downside.
Yeah, to the upside, 62.10, to the downside, 61.30. Once again, this is quarter end, so a lot can actually happen here, Diane. We have seen some very strong intraday reversals as well on this day. So I would say be very nimble when it comes to trading in today's session. Headline risk is definitely going to be there, but the mechanical risk and the rebalancing risk is definitely going to influence the markets today. And it should be actually fairly fun if you're an intraday trader.
All right, fairly fun day in front of us. Thanks, KG. That's our Kevin Green, Senior Markets Correspondent.